Hello everyone, we are from Group 12 for Group Assignment AKW104 for Financing and Accounting. This is my group members: Nurul Nabiha binti Muhammad Syukri, Siti Nurul Atika binti Mazlan, Siti Nurjanatul Husna binti Muhammad Yazid, Muhammad Khairul Nizam bin Kamaruddin Zamzam, and me, Nabila Najwa binti Muhammad Izal. Hi, my name is Najwa. Welcome everyone to our presentation on Panasonic and Panasonic. Today, we will take you through a detailed analysis of both companies, focusing on 4 key areas. Firstly, trend analysis results. We will begin by evaluating the financial ratios of Panasonic and Panasonic over the past few years. This will help us identify any patterns or performance trends that can give us insight into the financial health and operational efficiency of each company. Second, financial strength comparison. Next, we will compare the financial strengths of the two companies. Using a comprehensive ratio analysis, we aim to determine which company stands stronger in terms of liquidity, profitability, and solvency. Third, additional investment considerations. Moving beyond the numbers, we will discuss other critical factors that impact investment decisions. These include current market conditions, industry trends, and the strategic initiative each company is undertaking. The last one, investment recommendation. Based on our analysis, we will offer a recommendation on which company is better investment choice. This will be supported by a discussion on their future prospects and the developments we expect to unfold in 2024. Let's dive in.
Hi, I'm Atika and I will talk about the trend analysis for Panasonic Holdings Berhad and Panasonic Manufacturing Malaysia Berhad from 2020 to 2024. First, liquidity ratios. For Panasonic, the current ratio improved from 1.33 in 2020 to 1.52 in 2024, but the asset test ratio is still low, showing that Panasonic relies a lot on inventory. However, Panasonic has strong liquidity, with its current ratio growing from 4.55 to 5.15. Second, efficiency ratios. Here we can see that Panasonic's inventory turnover improved slightly, which means better inventory management. Meanwhile, Panasonic's receivable turnover was strong in 2022 but dropped in later years, meaning slower collection of money. Third, profitability ratios. From the data, Panasonic's net profit margin went down a lot and became negative by 2024, showing losses. However, Panasonic stayed stable with margins above 10%, showing good profitability. Next, solvency ratios. For Panasonic Holdings Berhad, the debt to equity ratio improved from 1.18 to 0.85, meaning less reliance on debt. For Panasonic Manufacturing Malaysia Berhad, the debt ratios stayed low and stable, showing strong financial health. Last but not least, market performance. We can see that Panasonic's EPS and market value dropped in 2024, showing weak performance. Meanwhile, Panasonic's market performance stayed more stable. In short, Panasonic is struggling with profits and market performance, while Panasonic is doing well in most areas.
Hello, I am Nurul Nabiha. I will presenting a financial comparison between two companies, Panasonic Holdings Berhad and Panasonic Manufacturing Malaysia Berhad. Let's start by looking at some key financial ratios for the year 2024. As you can see in the table, Panasonic consistently outperformed than Panasonic in every key ratio. The current ratio for Panasonic is 5.15 compared to Panasonic 1.52, showing that Panasonic has a much stronger ability to cover its short-term liabilities. Similarly, the asset test or quick ratio, which exclude inventory, highlights Panasonic liquidity strength at 4.72 versus Panasonic's 0.90. Moving to profitability, Panasonic net profit margin is a solid 11.12%, while Panasonic has a negative margin of negative 4.40%. Additionally, Panasonic's return on assets stand at 9.93%, showcasing efficient resource use, whereas Panasonic's is negative at negative 5%. Finally, the debt to asset ratio is much lower for Panasonic at 0.14, indicating a healthier financial structure compared to Panasonic's 0.46. This number makes it clear that Panasonic is in a much stronger financial position. Now, let's focus on the key strengths that make Panasonic a financially stronger candidate. First, liquidity. Panasonic high current ratio of 5.15 and quick ratio of 4.72 indicate a robust ability to meet short-term obligations without financial strain. This shows that Panasonic is well prepared for unforeseen challenges. 2. Profitability. With a net profit margin of 11.12%, Panasonic demonstrates exceptional cost management and strong revenue generation. Additionally, its return on asset of 9.93% highlights efficient use of its resources to generate profit. 3. Debt management. Panasonic debt to asset ratio is just 0.14, significantly lower than Panasonic 0.46. This indicates reduced financial risk and a more stable operational foundation. Therefore, these factors show why Panasonic is a leader in financial performance compared to Panasonic.
Hello, I'm Muhammad Khairul Nizam and I will present about invest decision. Let's look at the product range and market positioning. Panasonic Holdings focuses on affordable electrical appliances for local and regional markets, offering home appliances like refrigerators and washing machines, kitchen appliances such as blenders and rice cookers, small electronics including fans and irons. Panasonic Manufacturing, on the other hand, has a broader and more innovative product range, including consumer electronics like TVs and cameras, home appliances, lighting solutions, and industrial products, energy efficient and sustainable products. Panasonic's diversified and global presence gives it a significant edge over Panasonic. Moving on to growth potential. Panasonic Holdings shows limited innovation and relies heavily on local markets. Declining profitability and weak market performance further challenge its growth prospects. In contrast, Panasonic Manufacturing invests heavily in R&D, focuses on renewable energy, and benefits from a global footprint, making it well positioned for sustainable growth. Finally, for market stability, Panasonic has exhibited stable market performance over the years with consistent revenue growth and a strong market presence. This stability is reflected in its higher price-earnings ratios, which suggests that investors have confidence in its future earnings potential. On the other hand, Panasonic has struggled with declining earnings per share and market value, raising concerns about its long-term viability.
Hi, I am Siti Nurjanatul Husna. I am going to talk about company recommendations and the reasons we recommend it. Both companies have shown ups and downs in recent years, but overall Panasonic Manufacturing Malaysia Berhad is the company that stays stable and doing well in the most areas. Firstly, strong financial performance. Panasonic Manufacturing Malaysia Berhad has strong liquidity and good profitability, which means that this company has better financial performance than Panasonic Holding Berhad. In contrast, their net profit margin went down a lot in 2024. Furthermore, Panasonic Manufacturing Malaysia Berhad showing good financial health at solvency ratios. Acid test quick ratio. A low acid test ratio may indicate that a company is struggling or may not be able to get adequate financing from lenders. As the result says, Panasonic Holding Berhad has a ratio less than 1. That indicates the company struggle to pay debt or the liability. On the contrary, Panasonic Manufacturing Malaysia Berhad has a higher ratio that is generally better, which means the company has enough cash and liquid assets to pay its current liabilities. Lastly, wide products range. Panasonic Manufacturing Malaysia Berhad has high demand for product and the total revenue is higher than Panasonic Holding Berhad for straight 6 years. When the product sales increased, people started to trust this company and would invest during the years. It can be proven by market performance of Panasonic Manufacturing Malaysia Berhad. The price-earning ratio is most highly higher than Panasonic Holding Berhad, which means higher price
earning ratio can indicate that investors expect high earnings in the future, or that the share price has risen faster than earning. That's all from me.
Hi, it's me again, Atika, and I will talk about the future outlook for both companies. Panasonic Manufacturing Malaysia Berhad is expected to grow well in the future because it focuses on new and energy-saving products. It invests a lot in research and development and has a strong global presence. This helps Panasonic take advantage of new opportunities in growing industries like renewable energy and advanced electronics. On the other hand, Panasonic Holdings Berhad faces challenges. It relies too much on local markets and has low profits. To improve, Panasonic needs to make better products, manage costs, and expand to new markets. In conclusion, Panasonic is in a stronger position for long-term growth because of its good finances, innovative products, and strong market presence. It is more likely to give stable and better returns in the future. So that's all from our group. Thank you for listening.